Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Walter Johnson. He is a finance professional, real estate investor, and syndicator with over 16 years of experience, starting his own personal real estate portfolio with just a $1,500 investment. Today, his firm, Sonos Capital, invests in manufactured housing communities across the United States. Walter, thank you so much for being on the show today.
Thank you. Thank you for having me. It's going to be a cool show.
So you've been investing in real estate going on almost 2 decades. And can you tell us a little bit about yourself, both personally and professionally, prior to getting involved in investing in real estate?
Yeah, well, I think I was investing in real estate since I was 22. Yeah, that would tell you when I first bought my first investment property. But before that, it was a lot of education. So I remember, I talked to my friends and, read a lot of real estate books. And, I would, they were into different things, and I was reading about lending and LTVs and down payments. And I used to go to them and say, hey, there's like a Fannie Mae program or a Freddie Mac program. And you can do 3.5% down or 0 down, and you can buy a fourplex. And, they laughed at me. So I think that's when you kind of outgrow your friends, so to speak. And that's kind of when it started clicking. So I believed in, my passion more than believing just hanging out. And so I think that's what separated me to go to the route for real estate investment.
And that's really interesting. I bought my first multifamily property when I was 22 as well, in 2006, and it was a 3-plex house active. And I can't tell how many people I told to do the same thing I was doing, and no one did it. So it was like, it's you're a little different when you're taking that route because it's not traditional. You know what I mean? So you kind of have to change your networking group and change the people kind of that you're listening to and so forth.
Absolutely. Yeah. So that's how I got started. And then I got started. This was kind of a, I guess we would say a hack these days, right? But this is let's say a hack then. I said, okay, if I want to learn about real estate and how you buy it and what's the best way to buy it and like the ends, I'm actually going to get into mortgages. I became like a loan processor first, right? And that was kind of it was a temp job. And I said, okay, this is actually what I'm going to do, just to learn the business of real estate investment. And so based on that, then I seen these mortgage brokers, making a ton of money back at this is before the hype. This is probably 99. So, right. So 99, 2000, right. So they were dressed up in suits. It's a lot different what it is now. Dressed up in suits, and they were doing well, and they had the Benzes. I was like, okay, I want to be that. Right. It was almost that pursuit of happiness type feeling. And that's how I got into mortgage brokers.
Interesting. Yeah, that was quite the difference back then, because the internet hadn't come through, and the internet obviously disrupted tons of industries, and definitely mortgages and real estate, to some degree real estate, but mortgages definitely. I mean, you don't have to go to somebody's your real estate agent's mortgage broker anymore, and you can now find and contact lenders and brokers all over the United States. So it was definitely a different time, that's for sure.
Yeah. Oh yeah, absolutely. And at that time, they brought in, so I was a kind of a loan processor. They brought in these files. Right now, it's all digital via email, emails and all that great stuff you upload. But back then, they had to send in the documentation, and somebody had to copy the pay stubs, W-2s, bank statements, et cetera. So I was seeing these files, and then I would see how much the mortgage brokers were actually making. I was like, wow, that's cool. And they're always on their cell phones and, making deals. So yeah, it was cool.
Yeah. It's an interesting thing. And then I think, I remember I bought a second property in like 2008. And when I bought in 06 versus 2008, I mean, it was about exactly 2-year difference for me from those two closing dates. And the change in real estate, I mean, we hadn't even hit the bottom yet. It was just like 2008, just everything kind of blew out. And it was just, I had, it was different real estate agents that were there, but the brokerage, I remember my broker was telling me that the brokerage, the loan mortgage broker he worked for, this guy, his firm, he said they had 2 secretaries, and he said that one of them took care of like 23 of the different brokers that were out there selling mortgages, and him and one other guy had one secretary themselves. That's how many deals they did, because they had real Rolodexes back then of clients that they were getting business from. You know what I mean? And like, those are the people that stayed on. Everybody else kind of got washed out. All of these people are doing fraud and stuff like that. They didn't have real businesses and stuff like that. So it was definitely a definitely a changing time for mortgages and real estate. I mean, it was such a difference between those over that 2-year, 3-year period, going from '05 all the way to '09, '08, something like that.
Oh yeah, it was. I remember, I think I was like 23, 24. I had a personal assistant that I was paying. I had no management skills, but I needed it, right? So sometimes in that business, you need it.
Yeah,
necessity, because you have so much business.
So let's talk about how you kind of made the transition over to like mobile home parks, and how your kind of investing career kind of evolved from starting off in '08.
So starting off in '08, let's kind of go back to like '06 just a little bit, right? So I seen the market kind of make a turn before. I think if you're in the inside, that's what I wanted to tie it to. If you're in the inside, let's say mortgages or lending, you can kind of see what's happening before the general public, right? I would say that's safe to say. So it's usually about a 6 or 8 month gap, right? Until about into 2006, I started seeing the landscape change in lending. So a lot of programs, let's say for buying a investment property or a fourplex or a triplex, those lending opportunities or loan programs were actually going away, right? So, and then at times lenders just wouldn't approve them. So it says, okay, this is a little bit different. Until I stopped, I actually moved to Denver, and I kind of just retired, right? Because I had a lot of properties, and that was '07, '08. So in '08, I had a friend of mine that told me about mobile home parks, Jerry, and he sold actually manufactured homes to park owners, and he sold them from in Arizona, California. He was telling me, at the time I was doing a little bit of flips. But he said that because he would sell, let's say, a park model manufactured home in a home community. So he would buy it for, let's say, $15,000 or so and sell it to a park owner in California for $40,000. I think that, that'd be a great way, because you don't actually have to fix them up like a single family home. But he says, hey, so have you ever thought about, since you like real estate and income, have you thought about mobile home parks? And I said, no, not at all. Did never even cross my mind, right? Before that, I had no idea who lived in manufactured homes. I had no idea how it worked at all, right? So I kind of let it go and just said no. And then a couple years after that, I was looking at a wholesale, like we were talking about websites, and I seen a mobile home park go for really cheap, but the income was about $45,000 a month, which was, it's phenomenal, even still today. And I think the price was just shy of $400,000. So I said, let me learn. $45,000 a month gross is actually a lot of money. So I called Jerry up, and I said, Jerry, can you kind of tell me about mobile home parks? And so he told me a little bit about what he knew, but he introduced me to a few park managers, and then he introduced me to a huge park owner. I think they're probably the number one in California, or at least the top 5, I believe. But I believe they were number one. So I actually had an opportunity to meet, his name was Jim, to talk to this guy by the name of Jim. And it was a world of knowledge. And so I studied parks for about 3 years, solid. So I learned everything I could about parks. I put out mailers, and they would call me, seeing if they wanted to sell, and I would just pick their brains. It's almost similar to buying real estate, right? Talking to let's say a seller. And I just drove everywhere. I had a Prius at the time, and it's great gas mileage, so I didn't mind the drive. So I would drive to Yuma, I would drive to California just to drive and talk to these owners. And that's actually how I got my start in learning about manufactured homes or mobile home parks.
Interesting. Did you ever partner with them on any deals like that, or did you your first deal you just did yourself?
First deal I did myself. They were they're huge. We're talking about, there's a guy in Palm Springs, I think at the time, his, just the land alone was $10 million. So I just imagine what the park was worth. So I didn't have that capital at the time. And so I picked their brains. How did you get started? What did you do? What are your pitfalls? How do your tenants work? How does it compare to single family homes or apartment buildings? I just asked them all these questions. How do your utilities work? What is this? It's called a skirting. Why do you have steps like this, right? Like the simple questions, I would say if I was in elementary school, right? And that's how I got my start.
Interesting. So let's fast forward kind of to what you guys are doing now, kind of what your company's current investment criteria and strategy is, and kind of different like fund offerings that you guys are working on.
Sure. So it's funny how you say that. I just got back from Wyoming. We're actually going to be buying a park for about $15 million. That throws off about 23% cash on cash return. So it's actually a great part. Yeah, really good part. So let's just talk about that one, since I just came back and it's kind of, we're working on it in real time. So that criteria, one, it has double-digit cash on cash returns. It's seller financing. The down payment is 30%, which is not bad. And it's 80% occupied. So looking at something like that, I would say that's our buy box. We don't like to dip below, I would say 65% occupancy. And if you can buy something in that buy box, I think anyone will do well.
Interesting. How did you guys source that deal?
Our marketing. So we actually have marketing. So we do, we actually have people that call on park owners, and we do mailers. So it's a combination of both.
What have you found to be most successful, or putting them kind of mending them together makes it a successful kind of marketing strategy?
Yeah, I'd say blending them together. I would say a lot of it's timing. Some people may not, like the phone calls, or may miss it, but they might like how you wrote the actual letter, and vice versa, right? So some people just don't like the letter, but they appreciate a phone call. So it's a blend.
Interesting. Yeah, I think definitely direct mail is a very, very very successful avenue for sourcing multifamily properties. Definitely, I mean, unique properties and stuff like that, and sourcing them directly. It's we found to be extremely successful. You know what I mean? It's a great marketing channel. This one you said that you seller financed it, which I imagine is for these type of assets, that might be a higher percentage compared to other asset classes that are seller financed, compared to, multifamily or retail or self-storage, maybe in some parts. But what are your primary funding sources outside of seller financing for these parks deals?
I mean, you can get one. It's funny how you say that. We can go back to, when I was 19 talking about Fannie Mae and Freddie Mac. So you can actually get a loan now through Fannie Mae and Freddie Mac for mobile home parks now. But usually, what was the case is that you would actually, those mom and pops usually did seller financing when they acquired the park. So usually they're used to it. And I think they're more apt to actually take that. And the reason why I say that, because we structured a deal to where the park owner was drawing about $90,000 a year off this park, right? Not this one, but just another one that we acquired. So I said, okay, I will give you 20% down, and I will give you payments, which is, your mortgage, in equivalent to what you're actually paying yourself. So it's actually a win-win. So she's like, okay, well, that makes sense. And so they don't lose their quality of life. They just get a chunk of change as far as a down payment.
Interesting. Yeah, that's a great way. That's one of the benefits of seller financing, is that you're able to go in and really manipulate the down payment, the interest rate, and the terms of the deal specifically for what the goal is. Because in this situation, it wasn't really the sale price that they wanted a different price on. It was really that they wanted to have that income stream coming in. So you put it all together for it, and you're able to do it. Because do you find that what do you think one of the big hangups is when you're negotiating seller financing? Is it always the selling price, or is it something else usually in the background that you wouldn't have thought of first?
I think it's a background. That's actually a really, really great question for your audience. I think it's a background. I think it's the down payment and trust. So down payment, trust, and then the income, right? Or the payments that they'll get. But one, if they can trust you, if you actually have a track record. I like to meet with the sellers face to face. I'll go to breakfast, lunch, or dinner with them. It's actually great. You can hear their story, they can hear yours, and get some type of, create a type of bond there. That's one. But two, if you're actually saying, hey, I can, bring this $1 million or $2 million, or even $500,000 for your down payment. And then if you carry the paper, right, seller financing, that makes sense. So it's trust, down payment, and the monthly payments.
Interesting.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners, and since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
One of the things I've found when I speak to mobile home investors, I mean, due diligence is important with all different types of properties. I mean, obviously, we do a thorough due diligence with multifamily properties when we're buying them. But kind of what do you think are some of the due diligence that you perform for new mobile home park acquisitions that, might other operators that you might be competing with, they might overlook, right? Maybe not even competing with, but other operators that are out there, it might be something that they don't really do. And you guys are a little bit more thorough. You're going through them. And how does that really look, your due diligence portion when you're buying one of these parks?
Yeah. So we do phase one surveys. We do environmental surveys, which is almost unheard of. Let's say if you're buying a single family home, right? Or, a small duplex.
You do on everything, no matter who's financing it?
Mm-hmm. Yeah. At the bank, actually, usually if we're going through a bank, the bank actually orders that, right? And so we don't necessarily do appraisals because we actually look at the books, right? Or not the books, but I would say that the rent rolls, the P&Ls, the tax returns, right? We can kind of get it at this stage, a gauge of what we're looking at. But I would say one thing that we do is that that's a little bit different, or it could be a tip for your audience as well, is that we'll call the association in that particular state saying, hey, we're looking at acquiring this park. What should we know about, one, this park? Does it have a history of anything, or any red flags? Or are there any state legislations that are coming down that we should be aware of? So little things like that. And that's, I know it sounds like unnecessary, but it's a 10-minute phone call that can save you, hundreds of thousands of dollars and save time down the road.
Yeah, no, that's a lot of great information. One thing I've always found is that the infrastructure, and it's one thing we look at with older multifamily properties too, like plumbing, for example, but it's also just something that even with these parks, I've heard people that have, they perform due diligence on them and inspect them, and they're telling me, how terrible some of the infrastructure can be on some of these parks. So, I mean, thorough due diligence is extremely important, is what I understand.
Oh, yeah, absolutely. I mean, we were looking at a park in another state from Arizona, and we found out that we couldn't, it sounded like a great deal on paper, but when you do the due diligence, we found out, wow, this is actually out of compliance. We have to if we wanted to do anything, we had to actually basically shut down the whole park so we don't have the business. So we actually didn't end up buying it. I guess the zoning and setbacks were actually incorrect.
Oh, wow. Yeah, that's not something you can just correct. You know what I mean? So, we pretty much for multifamily value add type stuff, we're raising rent, we're going and we're doing work to units, bringing them more up to the area standard rents and quality. What is a standard value add strategy look like for a mobile home park?
So standard, raise rents and decrease expenses. I would do that just off the bat, right? There's always something you can actually decrease expenses on, right? I have one that I'm looking at, their credit card fees. They're just credit card fees of $40,000 a year. So, because they're not doing online, but if you actually do online and most states, if you actually have a credit card fee, it gets passed on to the tenant, right? So that's an extra, and then ACH doesn't cost any much. Doesn't cost anything. So we would be saving $40,000 a year. I think it's $46,000 a year by going online or ACH.
Yeah, $4,000 a month, really saving on that. That's crazy. But when you're because I speak to like self-storage operators and they'll tell me, oh, like a value add strategy there because what is that? And they'll say, oh, we bring in U-Haul or we do this or something like this to add another value add service to clients there. Is there anything else like that? I mean, you don't probably want to own many of the homes, so you can't really do anything there. But like that's pretty much the whole thing, going in there and try to raise rents a little bit so you don't have too much pushback. And then you're just going in there and because lowering the expenses, when we buy a property, we can lower expenses. I can, we can change out, say, trash, right? But that's like a one-time thing. You know what I mean? Obviously, it's like, it does it for year one and going, I'm not going to be paying the same as the last guy was for future years. But the thing, though, is that it's still, I'm not going to have another decrease or any other bump in income just off that. Is there anything else that you guys are doing that's going to kind of increase the NOI?
Sure. So we would bring in, there's another strategy. We'll actually bring in fiber optic internet, and so that's one. So we'll let that company actually get the rebate from the government. So they'll install it to us for free, but we'll actually charge the residents for the high speed internet. Well, we'll charge them. It'll be cheaper for them to actually go through us. That's one. And then two, let's just say if it's $40 a month, which is relatively cheap for, fiber optics. Well, you can times that by 100 spaces, where that's income generating, value add. That's one. Two, bring in new and used homes. That's another one. Another one is renting spaces. So if there's a vacant, empty space, you can actually rent that out. Someone can use it for storage. That's another one. Another one would be bringing in storage units, since you mentioned that. So we can actually just bring in storage units and have people actually rent those. And that's at $40 or $50 a month, but that's actually cheaper as well than, let's say, another mom and pop self-storage or, one of those big box self-storages down the street. So there's definitely other avenues to increase revenue.
Yeah, storage to the park is a double for you guys because you make money on it, but also it cleans up the park. You know what I mean? We have that with our apartment buildings. I remember we were checking on one property I was like 2 or 3 months ago. Everything was perfect, except people had stuff in front of their doors. You know what I mean? And you're like, we got to get this all cleaned up. Like, you can't have people storing stuff in front of their units. It looks like, you know what I mean? It just decreases what we're trying to do here. So much to new tenants coming in, people that are already living there, and your guests that are coming in as well. So the small stuff like that actually is, a win-win-win, because now those people don't have to drive anywhere to get stuff, their own personal items, access to it. So
absolutely. Yeah, no. So we're big on self-storages, and one we're actually doing with a park right now. It's where people have a lot of stuff in their yard. So we're cleaning that up. So I definitely understand what you're talking about.
One thing is that, you're dealing with older properties, and this is with any type of older properties. And there's certain things that are grandfathered in. There's always kind of that. There's might be some zoning or, regulatory restrictions when you're renovating or upgrading a park. I mean, how are you guys navigating that? I mean, is it just, obviously you do a lot of due diligence beforehand to make sure that there's nothing or immediately that's happening. But when you're going through and, doing this value add strategy with work you're doing there, how are you kind of navigating all of that to make sure that you're keeping everything above board and it's not going to come back from some local municipality?
Yeah, usually mobile home parks are grandfathered in. If you're trying to, I would say, get anything rezoned, then it gets out of that grandfather clause, and you don't allow it, or you have to build, let's say, a structure. Then it kind of changes things. So we don't usually do that.
When you were handling these parks after you purchased them, you have them all over the place. I mean, how is the property management handled? Is it something where, obviously you're looking for a certain size park where it's going to make sense and make it a little easier for you guys to manage it. But typically with your parks, how are they handled? Do you have a third party firm? Is there someone on site that lives there that's handling them? Are you guys, just one of your team members just does it offsite?
Both. I would say, so we don't have any third-party management companies. Either our managers live off-site or they live on-site. Our maintenance guys live on-site or they live off-site as well. We prefer them to live on-site, not necessarily just so they can keep an eye on the park, but it's cheaper for us. So if we can buy a park and have someone live on site, we can give them free rent. They pay their utilities, but free rent. Give them a small salary versus giving them a larger salary, because we don't have that. I guess we don't have that that incentive to give them free rent.
Interesting. Yeah, that's a great process. So some of the advantages that I usually see when working with listening to people about mobile home parks and whatnot, and it's pretty much that you guys have a moat around your business because they're not really building anymore. And if they're building more, they're very high-end parks, right? And I also feel that with the cost of housing that keeps on going up, it keeps people pretty much in that almost single-family type mentality of living. because it's much different going into an apartment after you've been living in a house, say if you came into financial difficulty. But going further, what are some of the disadvantages or complexities of mobile home park investing?
Complexities and disadvantages. I would say that it's a lot more moving parts than, let's say, a single family home or an apartment building. I would say that. Absolutely. So when you buy let's say a fourplex, most likely you're not doing an environmental survey. So you don't know what that looks like. And most likely you don't know how to read that and absorb that information. That's one. But then if you actually have to get a phase 2 survey, so that information, right? That's different. Two is that when you're buying, let's say, a fourplex, right? You don't necessarily have a P&L, right? On these, you do have a P&L, so you want to go by line, and might actually look at tax returns, and that goes back to me being a mortgage broker. I just probably read about 13,000 tax returns. So looking at tax returns is probably second nature to me. However, you still have to read them. So little things like that.
Interesting. Now, getting into your business of what you guys are doing, you're raising money through funds. How has going from or into a fund model benefited both you and your investors from a, I guess, traditional investing strategy of just a one-off syndication, which I think is more normal for larger, say, multifamily assets and other assets like that. But I feel the fund model is much more common with people that are picking up smaller self-storage and mobile home parks.
I would say the fund is actually a more, what's the word I'm looking for? Less exposure, less risk than one-offs. I would say that a fund, because it spells out what you're going to do. But to me, like a syndication is just a one-off. It's like, hey, we just want to buy this property. We want to make money, right? So let's create this agreement and then let's buy it. Fine. Fund saying this is actually what we're going to do. This is how the money is going to get distributed. This is when and so I think, and per the SEC, I think, if anything happens or you had any legal challenges, the SEC would put, if anything came in, a fund would actually look more favorable.
Yeah. No, I can see that. Yeah, definitely spreading the risk is a huge benefit with that because it gives you a lot more for, say, a $50,000 investment. You're getting exposure over X many parked, and you know what I mean? And markets and all the municipalities and all the risks get really watered down because the chances are that's happening at multiple parks is rare, whatever might happen. You know what I mean?
Yes. So we have a park that's doing 40% cash on cash return, which is great. Then we have one that's doing like 21% cash on cash. It's great. And then we have one that's 19. But if you look at that, I mean, even if someone said, hey, I'll put $20,000 in, it's really difficult for them to actually lose money with those type of returns and that many properties, let's say.
Interesting. So kind of as we're wrapping up here, I always like to ask people, especially yourself, you're going on 17 years of real estate investing experience, plus all of your experience just working around investors and property owners. What are some common mistakes you would see mobile home investors make over your years of doing this?
Oh, a mobile home park. I would say not doing their due diligence and just buying something just based on, the numbers. And not really diving in deep into it. So I say if somebody's like, hey, I think this is actually a great 10% cash on cash return or 12% cash on cash return. Well, I mean, that's relatively low in our world, right? Unless you're in, let's say, California or Oregon, Washington or something along those lines. But for the most part, if you look at those returns compared to, let's say, a single family home, it looks great, but I think we're chasing higher returns here. So I think looking for actual deals.
No, it's the due diligence is a killer. It's a mistake I think all new investors make. You know what I mean? I made it myself. You know what I mean? But it's something that you just kind of have to learn from mistakes. It does.
Yeah. I would say one. I mean, to help people, is that usually there's a 45-day due diligence and then like a 60-day close, something like that. I put my 60-day due diligence and 60-day close. So if I find out something at the 12th hour, I can cancel that because you just never know.
Right. That makes perfect sense. So Walter, as we're wrapping up here, let's say over this couple decades of you being a professional, what are some of the main factors contributing to your success over these years?
Mentors, learning on my own. I would say networking in a sense, right? So networking with the right people and having the right circle around you. That goes back to, my friends at 19, 20 years old. So having those people that will support you and understand where your struggles and what you're going through. If I didn't have, I say, the mentors that I have and the people that I can really talk to about, investing or like what you go through investing, I don't think I would be in this position I am today.
Yeah. Wow, that's a lot of great information. So how can our listeners learn more about you and your business?
Yeah, just go to sonoscapital.com. I'll reach out if someone actually has just a general question, just Walter at sonoscapital.com, or give me a call in my office, 480-674-2035. The reason why I give out my information is because I've been there before.
Well, thank you so much, Walter, for coming on today. We will put that link and phone number into the show notes, just letting you know people at Sonos. So it's SONOS capital.com. And Walter, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Absolutely. Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.